Passive income is easy money. That's what most investors say, and that's why everyone is looking for the best business ideas that can earn passively. It can be an elusive dream, but there are actually a lot of opportunities for passive income, especially in the stock market. Hey, welcome to Stock Market Mate. Today, we'll talk about the 5 best passive income stocks to own in 2022. Make sure to subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. We're quite sure that you've heard of dividend stocks. Investors know that these stocks stand out as an easy way to generate recurring income. The stocks that we're going to mention today will surely have a solid long-term growth prospect that will generate the best passive income. Stock number 5. Microsoft. Microsoft is a notable tech stock that pays dividends. The Washington-based tech giant currently offers a dividend yield of 0.91% and has a PE ratio of 33.70. Microsoft's corporation revenue in the first quarter of 2021 came in at $37.2 billion. That has increased for about 12% from the first quarter of 2020. During the COVID-19 pandemic, the company's online meeting platform Microsoft Teams benefited from the work-from-home setup and achieved a new daily record of 2.7 billion meeting minutes in one day, up from 900 million minutes in 2 weeks. Thanks to a combination of strong revenue growth, fast-growing profits, and consistent annual dividend increases, the software giant has become a must-have for many dividend investors, and the company's last dividend increase reiterates its strength as a dividend stock. In the second half of 2021, the $2.2 trillion tech company announced an 11% increase to its quarterly dividend. Impressively, the dividend hike actually marks an acceleration from the 10% dividend increase the company announced in 2020. The robust dividend hike and Microsoft's new share repurchase program together reflect the strength of the software company's underlying business and its recent performance. Sure, Microsoft's dividend yield of less than 1% may seem unappealing at first glance, but you should realize that it's likely the software giant's dividend growth will average a growth rate of approximately 10% annually for the next 5 years. Its revenue has been increasing consequently every year, and it's sitting on an enormous cash pile with no signs of slowing down. Although dividend yield is not the greatest at Microsoft, the company is growing at an unprecedented speed, and we won't be surprised if it hits a $2 trillion valuation in the years to come. Overall, if you want a safe investment that'll pay constant dividends, you should think about Microsoft. Stock number 4. Johnson & Johnson. Many investors are aware of the reasons to invest in Johnson & Johnson. Johnson & Johnson's biggest strength is its diversified business model. It operates through pharmaceuticals, medical devices, and consumer products divisions. It comprises some 250 subsidiaries, which clearly means that the business is extremely well diversified. Its diversification helps it to withstand economic cycles more effectively. Meanwhile, J&J has one of the largest research and development budgets among pharma companies. On January 4 this year, declared a $1.06 per share quarterly dividend in line with the previous. The dividend will be paid on March 8 to shareholders of record on February 22. The company has offered 59 consecutive years of dividend growth and is one of the top stocks for passive income in 2022. With a track record of 60 consecutive years of annual payouts, Johnson & Johnson has earned the name Dividend King. And with a solid business, this company looks like it's set to continue rewarding shareholders with more dividend increases for many years to come. If you're leaning on investing long-term, Johnson & Johnson might be one of the best passive income stocks for you. Stock number 3. Apple. Another well-known tech stock that's great for passive income is Apple Incorporated. The California-based technology company manufactures and markets electronics, computer software, and online service. From 2016 to 2020, Apple has acquired more AI companies than other tech giants including Accenture plc, Alphabet Incorporated, Microsoft Corporation, and Facebook. Apple acquired a total of 25 AI companies in 5 years. The company smashed past Wall Street estimates with a solid set of numbers when it released its fiscal 2022 first quarter results on January 27, putting to bed any concern about supply chain challenges hurting the tech giant's terrific momentum. With so many tailwinds at its back, buying Apple stock looks like a prudent thing to do right now. It is trading at 28 times trailing earnings, which is lower than last year's earnings multiple of 31.6. Its price-to-sales ratio of 7.6 is also lower than 2021's average of 8.2. Over the last 3 years, Apple's free cash flow per share is up 77%. Further 5G upgrades, new product demand, and continued growth in the higher margin services segment should drive even stronger free cash flow over the next several years, sending the stock higher. The stock is not cheap, but Apple holds a brand name that people around the world value and are ready to pay the extra. It's one of the safest companies in the world, and not even the pandemic is enough to stop it from growing. According to analysts, the company's earnings are expected to increase at an annual rate of 15% for the next 5 years. though it wouldn't be surprising to see it clock a faster pace of growth. All this makes Apple a top tech stock to buy right now, as it offers solid growth and a steady passive income. Stock number 2. Lowe's. With over 2,000 stores and 300,000 employees, Lowe's is an overwhelming retail force in the home improvement industry. Since 1961, the company has also traded publicly on the New York Stock Exchange under the ticker symbol LOW. Lowe's Companies Incorporated is the world's second largest home improvement retailer. It serves 17 million customers a week in the United States, Canada, and Mexico. The company offers a diverse range of products and installation services. The company has shown strong growth in all parameters. The year-on-year performance has been particularly impressive. For the fiscal year 2018, its sales revenue touched $68.619 billion, marking a 5.5% increase from the previous year. Earnings for the same period were reported to be $3.436 billion. Lowe's is a dividend king, and it has raised its dividend for the past 57 years. Its dividend yields 1.15%. Lowe's stock gained 174% over the past 5 years. The company is making moves to increase market share and sustain growth, and these moves are producing results. Building on top of the advantages of home improvement stocks in general, Lowe's offers a few specific advantages as an investment. The company's share price history over the past 5 years has been remarkably positive, with an approximate increase in value of 115%. Overall, Lowe's is typically classed as one of the most historically reliable dividend-paying stocks, just like Johnson & Johnson. In the last 5 years alone, the company has raised its quarterly payout per share from $0.18 to $0.55, an approximately threefold increase. While you should always consider your own investment strategy and risk tolerance when deciding to purchase any stock, Lowe's is an attractive opportunity for investors looking to take advantage of the booming home improvement market. Stock number 1. Home Depot. Home Depot is one of the biggest companies in the US, with a market cap of around $387 billion. The Atlanta-based home improvement retailer is often viewed as a proxy for the US housing market. Their stock has soared roughly 51% as a result of its marvelous business performance. Home Depot has also been going strong thanks to the momentum in the home improvement industry, which has been benefiting from sustained demand from home improvement projects and a robust housing market. Home Depot in particular has been gaining from growth in pro and DIY customer categories, digital momentum, and its ongoing investments. It remains on track with the execution of the One Home Depot investment plan, which bodes well. The aforementioned factors helped the company deliver a robust performance in the third quarter of 2021. The company reported sales and earnings beat for the 6th straight quarter and third quarter fiscal 2021. The top and bottom lines also improved year over year. Home Depot has had a robust earnings beat streak for the last 4 quarters, the average being 12.1%. This underlines the company's operational excellence. Overall, the solid execution of growth strategies along with compelling product offerings has been helping the company to efficiently meet demand conditions. This, along with favorable conditions prevailing in the home improvements market, is likely to keep supporting Home Depot's growth in the days ahead. This makes it a great passive income source for the years to come. The dividends of the companies we mentioned today may not sound impressive, but when we talk about passive income, we're aiming to invest in safe stocks that you don't have to monitor every hour. Sure, there are many companies out there that offer high dividend yields, but those are highly volatile. This is why we need to pick the safest options. Well, that's about everything. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!